So Joseph, welcome back.
Oh, hey
Great
guys.
day.
Thanks for
Yeah,
inviting me. It's a pleasure to be here. Can you hear me?
yeah, great day, great timing to have you today. Do you have any expectations about Jerome Powell's speech this afternoon?
Yeah, that's the question of today.
Yeah,
Honestly, I don't know what he's going to do, and I'll tell you why.
okay,
So usually what we expect in the past is that so Jay Powell says something, the markets rally, and then Jay Powell gets mad. He comes back and he finds an opportunity to talk the markets down, right? That's
right.
been the pattern the past year. And, I don't know if he's going to do that again. The reason I don't know is that back at the FOMC presser last week, he had the opportunity to talk the markets down. He was asked repeatedly
Right.
what he thought about financial conditions. And
Yes.
Jay Powell, he knows what that means. He knows what to do, and he just kind of sidestepped it. In fact, he seemed pretty open to even modifying his expected rate path if
Okay.
data was softer than expected. So he seemed to not want to do that anymore. So now that he has this meeting scheduled, I'm not sure if he's going to talk down the markets because it seems that his reaction function has changed. He's more comfortable with the path of inflation, so maybe he doesn't feel the need to talk down the market anymore.
Okay. I know Larry Lindsay was on CNBC and thought it was one of the worst Fed speeches he's ever heard, and that his demeanor, it was more about his demeanor, which you're talking about. He was the good cop the other day. Yeah, so he goes between good cop and bad cop, and but you think that he's gotten comfortable with what's going on in inflation. So I want to ask you, the market was, kind of, fighting it was described as fighting the Fed, but the employment report we had Friday led to a pretty nice technical breakout in 10-year yields. Do you believe that this has staying power and that we could actually 10-year note could rally to above the 4% level into the end of the year?
I do. So this
Okay.
has more to do with my just general macro view that we are in a regime change where inflation is going to stay persistently higher than it was in the
Okay.
past. So I think the lows for the 10-year, the generational lows for the 10-year are in, and
Yeah.
we are going to reverse that downward trend from the past few decades, and we're going to gradually grind higher. So I do expect the 10-year to finish the year above 4%.
Okay.
So
Don't you
I
think the
think
market's a little bit wrong-footed on that expectation?
I think the
I know
market.
it all changed Friday, but aren't there a lot of people that are saying, well, there were anomalies in the NFP report and it'll be revised next month, and they're not. And I even heard a guy say, well, it was only 2 up days in yield. So a lot of people are trying to say it, just a little trading blip, and there wasn't significance in what yields did in the last few days. Um, do you
Yeah,
think
yeah.
that, yeah, do you know what I mean? That people are
Yeah, absolutely.
downplaying the NFP?
So when I look at the markets, I see a very strong bias towards towards the view that Fed is just going to cut rates, we're going to go back to
Yeah,
the old regime and so forth. And you
yeah,
can see that, like you said, people have been fighting the Fed all of last year too, and they've been losing, right? Old market adage, don't fight the Fed. So, and sometimes the Fed is wrong, to be fair. But the broadly speaking, though, don't fight the Fed on the way up, and I wouldn't fight the Fed on the way down either. So,
okay,
to the view of those people who are doubting the Fed, I think that when I look at the markets, I think that markets always think that the future looks like the past. And we can clearly see this when we transitioned out of the great financial crises. Before the great financial crises, our Fed would routinely hike rates around, let's say, 4 or 5%, and then cut a bit and so forth. So
yeah,
after the great financial crisis, if you look at the market, it was always pricing that the Fed would just go up to, let's say 4% in a few years, right? That's what they were always thinking, and they were always wrong for many years. It wasn't until, of course, today that we actually went up to, 4%. So those guys, they were wrong for almost a decade. But
Yeah, it's like
over the
recency bias.
exactly.
You
And
know, go ahead.
over so over the years, the market gradually adjusted that, maybe we're not always going to go up to 4%. And the market now thinks that we're just always going to towards zero because the Fed is just always going to cut rates all the time. So it thinks, like you mentioned, recency bias. It thinks the future looks like the past. And the past has been a world of low interest rates and a Fed that's eager to cut. But
Right.
what I think the market doesn't realize is that inflation fundamentally changes the Fed's reaction function. And so that means we're not really going back to let's cut immediately to zero again. So it's a different world, and it's going to take time for the market to digest, but it's getting there.
Okay. Last time I talked to you was at our Trader Summit in October, Joseph, and people don't know how I could remember what people said months ago, but I want to congratulate you. You were talking about risk on in October, and that was a great call. That was an important bottom that you called. The other half of the equation was you thought the dollar would rally with the market, and the opposite happened. Now we're getting a bounce in the dollar. Has your view on the dollar changed with that big decline that we had, and this might just be a bounce in an otherwise bear market in the dollar?
I actually, so this huge bounce in this huge sell-off in the dollar the past couple months, I didn't expect that. And it seems to me it has to do with the bias of the market in rapidly pricing in rate cuts, thinking would go back to I guess pre-COVID framework.
Okay.
And when the market prices in rate cuts, a lot of things happen. Risk assets rally as they've been rallying, and also the dollar sells off. Okay. Now, because I think that rates are going to be higher for longer, like Powell said, I think the dollar will strengthen from here. And actually, among all the asset classes that I trade, I'm most comfortable with long dollar right now. And I'll tell you why. Okay. So I'm most comfortable for long dollar because of how the financial system is structured across the world. So if you think about it, so a central bank hikes rates, not just the Fed, but any other central bank, and they expect that to go through the economy and slow everything down, right? But you have to think a little bit more as to how that works. So it works in a number of ways, and how it works depends on which country you are, because every country is different. In the US, in Canada, in New Zealand, in the UK, a number of Euro countries, for example, one of the ways that works is that when they hike rates, it directly feeds into the mortgage rates of the households. So households there have either variable or have mortgages that renew in just, let's say, within 5 years. So the households are very, very, I guess, sensitive to interest rates. So you can just hike a little bit and immediately people feel the drag. They have to pay more on their mortgage payments. There's less demand and the economy slows. That's not the case in the US. In the US, our financial system is structured such that both businesses and people are very resilient to interest rates. If you look at households, we have 30-year fixed rate mortgages, right? So basically everyone is locked in around 3%. Right. You can raise rates a lot. It's not going to affect them. Their interest rates are low. For the corporate sector, a lot of people borrowed a ton during the pandemic, and they don't have to have, there's not that maturity wall of refinancing until I think another year or two. So so in the US, if they wanted to slow the economy down, they'd have to hike rates more than other countries. Other countries don't have to hike as much. And that short-term interest rate differential will become more apparent when inflation stays higher than longer. And so I think that's going to strengthen the dollar because the dollar will have to hike more than the other countries.
Okay, because a lot of people have been rationalizing their long euro, and I could tell one of my associates wants to talk to you. But one of the fundamental rationales was the interest rate differential, that Europe was going to remain tighter and more hawkish than the US, and you're saying that's not going to be the case.
Yeah, I don't think that they can. So if you look at it, so again, how monetary policy, so you're hiking rates, and its impact on the economy is going to depend upon how your financial system is structured. One
Right.
interesting about Europe is that if you look across the European Union, some countries, let's say the Iberian countries, Spain, Portugal, for example, tend to have mortgages that are, I guess, more variable, and
Yeah.
other
Like
countries,
Canada.
yes,
Canada
yeah,
too.
like that,
Yeah.
like,
Yeah.
and other countries in the Europe have, fixed, very, let's say, 20-year mortgages. I think that's how it is in France.
Okay.
So you have this additional political problem here, where when you hike rates, you really screw some countries, but other countries, you don't really do anything to them. So I think that makes it difficult for them to continue very aggressive rate hikes.
Okay.
Joseph, sorry to interject, Steve here.
Go ahead.
I have a question, a follow-up question having to do. You just said that you feel comfortable being long the dollar. So my question there is, looking more for a rebound, or do you actually believe that the dollar can produce new highs within the months ahead?
I think it depends on the currency pair more. So I'm long the dollar.
Let's talk about the
Okay.
DXY, for example, which is the
Okay.
index, right?
So can you pull up a chart of the DXY? I don't. So I
Got it.
usually look at currency pairs rather than.
All right. So there was a
Uh,
high, Joseph, 14.5 back in
yeah.
September, late September. And then, if you're more comfortable making a comment about an individual pair, the euro makes up of the majority of the dollar index. So I guess
No,
Steve
I
would
could see the euro going with the retesting one parity again is how I
parity.
think is how I
Okay.
retest it. So I wouldn't actually I feel comfortable thinking the euro would go below parity by the end of the year, and that's kind of how I position myself. So
Okay.
I mean, there's some geopolitical kicker in my view, and this is just aside from monetary policy. Monetary policy alone, I think, gets it to close to parity, but I think that there's significant geopolitical risk that's not being priced into the markets.
Like Russia doing better in Ukraine?
So when I think of the conflict between Russia and Ukraine, it looks very much like a proxy war of the West against Russia. And
Yeah.
when I hear what the U.S. is doing, I think they want it. And if you want it, you're going to get it. So so that's how I
Okay.
look at this. So I would say this actually. So in 2020, I was looking at what was happening in China and the COVID and all that stuff. And I was really surprised that the market did not react to that here. And I was really positioned for that. But the market just went up every day. It's like they completely ignored this huge development in a really big part of the world. And I think something similar is happening here with the Russia-Ukraine conference, and that guys, they're obviously fighting a proxy war with Russia. Everyone is sending Ukraine weapons, and they're sending more and more weapons. This can't end well. So you have some serious terror risk that this could escalate, and if it does, you have an immediate, tremendous flight to the dollar, and the euro will suffer.
Okay, interesting. And what about the reopening with China? Does that play a role into possibly keeping the Fed tighter for longer, as they were locked down, and that energy use is going to go up, everything's going to go up if they're successful with the reopening?
I don't know. So
Okay.
when I look at China, so there's like you mentioned, when you reopen an economy, people do more economic activity, and there's more demand for certain things like commodities. Although you haven't seen that in oil at all. And on the flip side, though, when people go back to work, they start working in factories and so forth, the supply of goods and services increases significantly. So you have a demand increase and also a supply increase. And how that works out, I think it's probably going to depend on an industry by industry basis. Maybe some industries were particularly constrained by shutdowns in China. Now they can get their goods and services again, and maybe others won't be as affected. So I think there's more nuance to that I'm not.
Okay.
Super
You see any
close
geo
to.
risk with China? And we're in at least a Cold War with them now. just like you say, we want this war with Russia, the proxy war. Does China want war to be able to absorb Taiwan? And, what do you think about the balloons popping up over?
Uh,
It definitely wasn't a hot air balloon where you take a nice little ride. So, you have any
so
thoughts on that?
yeah, I'm really surprised about that. I think that was a big nothing. So obviously, China is spying on the U.S., right?
Yeah,
U.S. is spying on China, China is spying on U.S. Same for
right,
any other country in the entire world.
right.
Why that deserved a tremendous amounts of news and so forth, I don't really know. So I don't I
Okay,
don't know why the
that's fair.
administration wanted to play that up.
Okay.
Yeah.
Well, I've heard some people say, well, it shows that we can't control our own airspace and just
Uh,
let it float across the country.
for
That they may have been testing our reaction to what we would do.
For all I
So,
know, somebody got their budget cut and was upset and wanted to blow up that
yeah,
issue so that they would get more budget. So yeah, I really don't know
okay.
why the press focused on that.
Okay. Has your view on risk changed since we've had this pretty dramatic rally, and really the January effect in my career, I've never seen a better January. Have you?
Well, you have a longer career than me, and if so I take your
Don't
word
rub
for
it
it.
in.
Hey,
What do you,
it's good. So you have seen a lot, so people should listen to you. So I don't know. So when I look at
that's
equities, I'm not super clear. I don't have a strong conviction.
okay.
I would be happy that I would actually not be surprised if we just mud around around this range. I'd say between 4,100 and well, I guess the 3,600 lows of last year for
Okay.
the rest of the year.
All right. And anything else that you might want to wrap it with that you'd like to share with us? So higher yields,
Yep.
part of the structural thing.
Yep.
The employment picture, Joseph. Maybe we could talk about that. Wrap it with that. I mean, how do you resolve a labor shortage with higher rates? How do you get people to go back to work?
So it's hard to get people to go back to work, I think, for a couple of reasons. One is that, uh, well, boomers just don't have to work anymore. I mean, think about all the people who bought homes for like, $50,000, like when
Yeah,
they were growing up. Now they're like, 100,000, few hundred thousand, $1 million.
yeah,
Seeing people had invested a little bit in the stock market. It's went up a
right.
lot. So you blew this huge asset bubble over the few decades. And at the end of the day, there's just not a lot of need for a lot of the boomers to work. And so a lot of them have been retiring early. And
Okay,
so that's one thing. The second thing is that um, I think that we have shortages in certain areas, and that has to do with the fact that labor shortage that has to do with sociology. We trained an entire generation of kids to go to college and blah 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 and something like that. But that's not really what we need today. We need people who do jobs in trades, who are more
right.
hands-on with their approach. And
Yeah,
we're just kind of taught all these kids that that's not good. We shouldn't do that. Even though, I'll say, for an average person, going to your local college and studying English, you're not going to get a job. But if you go and study welding or something like that, you can get a really good job and you can do really well. So I think we have this structural mismatch that's in part due to sociology. And the third thing is that we just have a workforce that's just not growing anymore.
yeah, the
Families,
demographics.
yeah,
Yeah,
we had small families back in the 70s and
yeah.
80s, and so that's changing. So I think the labor market is going to stay tight for the next 10 years at least.
I'd like to just bring this up and get your thoughts on it. Recency bias that you've talked about. So we really never had any huge spikes in volatility. People were buying, hedging of volatility and buying puts all last year, and most didn't get paid, especially in VIX. So if you don't get paid with what the market did, 30% lower, there's people saying, well, now is not, it's a waste of money to hedge. That's kind of the way that people are looking. The VIX is broken. And with some of the things that you're talking about, as far as an expansion or more, spreading of this war in Ukraine, I would think that it might be a good spec to look at, maybe buying some call options on the VIX going forward. What do you think? Is
Well,
volatility dead?
So like you mentioned, it does seem like, VIX, so puts haven't been working very well as a hedge, so people don't seem to be buying as much, and so that leads to less demand for volatility. So I own puts on the S&P. That's how I would get exposure to volatility rather than the VIX. Especially now, from my perspective, it seems like the S&P has had a run, and so it's kind of towards the top of the range that I would expect throughout the year. So, you would get exposure to volatility and to delta on the S&P. So that's how I'm positioned.
Okay, and I just want to bring up your website here for people to, it looks like there's a change.
Yeah. Oh, well, I have fedguide.com. So fedguide.com is where I would write my market commentary. I would check that out. So if you're interested in, so I do three things. I do on fedguide.com, I write about recent market developments that you can check out, most recently on Governor Waller's comments on having QT for longer. If you're interested in more basic principles about how the financial system works, I could recommend Central Banking 101. And if you'd like to have a basic introduction to macro asset classes, I have a course called Markets 101 as well.
Okay, so if you're looking for an expert when it comes to Fed speak and what they're doing, you just listened to one for the last 25 minutes, Joseph Wang. And I recommend that you try and get some clarity about the Fed, that Joseph's a go-to guy for that purpose.
Hey, Dale, just really quick, I just want to jump in and say, Joseph, thanks for spending your time with us. It's always a pleasure to hear you on the F.A.C.E show, and when you're blessing us and our community with your knowledge. You're definitely one of the most knowledgeable figures out in the social media space on the Fed. So thank you for all your commentary.
My pleasure. Thanks so much, Dale and Blank. It's been a pleasure being on the show, and I hope happy trading. Good luck to everyone.
Good hunting, my trading warrior brother.
All
right, Joseph, thank you so much. Joseph Wang, everybody. Hope you enjoyed it. I'll get in touch with you, Joseph, keep you in the rotation, and you could join the team in 20 minutes for the morning edge. Remember, don't just count your pips, count your blessings, and hope you enjoyed what we did here today, and I'll see everyone tomorrow. Good hunting. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.